Hello everyone and welcome to today's session for a quick fire revision of a much awaited and a complicated standard, Ind AS 19 on employee benefits. Now this is one of the most complex standards that is there around and it kind of is fairly tricky. So we'll try to cover that up in a nutshell for your quick revision. So what is employee benefits? Well, Ind AS 19 covers every category of employee benefit except for share-based payment because there's a separate accounting standard, Ind AS 102, which governs the same. So what are the other types of benefits? Well, the standard segregates that into four main categories. First, you have the short-term employee benefits, which are those benefits which are payable within 12 months, like salaries, bonus, wages, etc. Then you have post-employment benefits which are payable at or after retirement, like gratuity is payable at retirement, whereas pension is payable after retirement, so that is post-employment benefits. Third, you have termination benefits which are paid at the stage of an abrupt termination, which can be voluntary, that is VRS, or it can be a firing, like a retrenchment, so that is a termination benefit. And lastly, you have other long-term benefits, which is like a residual category. So if an employee benefit does not fall within the short term, within the post-employment or termination benefit, it goes into other long-term. For example, a jubilee bonus. So if an organization has a policy that if an employee completes a 25-year silver jubilee, let us say in my company, I'll pay him, let us say 25 lakh rupees. So that is a jubilee bonus which is paid not within 12 months, not at the time of retirement, so it goes, let us say, into the other long-term benefits category. Now we'll segregate each of them. In my opinion, the most important is the post-employment benefit working. However, we'll segregate and try to understand the accounting for each of them, starting with short-term benefits, where you have something like salaries and wages, which will be recorded as and when the service is rendered. If the service is rendered in the current month, but we get salary for, let us say, 4 months, then there will be some advance salary which will be shown as an asset. Or if there's service which is rendered and salary is not paid, then we will show a payable or a provision for the same. Second is bonus or profit sharing plans. It is to be recorded when the obligation arises. So in case of performance bonus, the obligation arises when the bonus is declared. In case of retention bonus, the obligation arises when the retention period is completed. In case of a statutory bonus, the obligation arises as and when. Under the law, the obligation to pay bonus arises. There can be profit sharing plans, like an MD gets 5% of the net profit. So this is a profit sharing plan which will be recorded as and when the profit is earned. So basically, bonus will be recorded as and when the obligation arises. Now the most important part, or the more complex part in my opinion, in this section is the accounting for compensated leaves. In short, this is kind of paid leaves. So over here, there are two categories of compensated leaves. One, there is accumulating compensated leaves. Accumulating means leaves that can be carried forward. So if they are not utilized in the current year, they can be carried forward, let us say for another 12 months, and hence they are short term. Or non-accumulating, which means if there are 30 leaves which are entitled and you took 20 leaves, in which case 10 leaves you did not take, so these 10 leaves will lapse. You cannot carry them forward. These are called as non-accumulating leaves. So if there are accumulating leaves where you can carry forward and utilize these leaves in the next year. However, there is no leave encashment. So if those leaves are not utilized in the next year, they will kind of lapse. So there is no encashment. These are called as accumulating non-vesting leaves. On the other hand, if you can carry forward the leaves and even claim an encashment if you don't utilize them, these are called as accumulating leaves which are vested. So over here, these terms kind of, they're fairly long complex words, and hence this kind of creates some trouble. However, vested benefits are those benefits where encashment can be claimed. Non-vested benefits are those benefits where encashment cannot be claimed. Accumulating leaves are leaves where you can carry forward, and non-accumulating leaves are leaves which cannot be carried forward. Okay, so when we are looking at compensated leaves or paid leaves, for simplicity, let us say these cannot be encashed. They can be carried forward, but they cannot be encashed. Then the standard over here says that you will have to create a provision based on the leaves that are expected to be utilized. So for example, if there is a 30-day entitlement and you have utilized 15 days, which means for the remaining 15 days, you will utilize those leaves in the next year, but the leaves accrue in the first year, and hence in the first year you will ideally create a provision for the 15 days of leave which are not yet utilized. However, based on past experience, if it is seen that out of those 15 unutilized days, only 10 days are going to be utilized, then you create a provision only for the expense that you expect to be incurred, that is to the extent of 10 days. You will create a provision for the leaves which are unutilized and expected to be utilized. On the other hand, if these were leaves which cannot be accumulated, which cannot be carried forward, which means in the next year you cannot carry forward these 15 days, in which case there will be no effect. You will not create any provision for these leaves. If these are vested benefits, that means you can encash the same, in which case if there are 30 days out of which 15 are utilized and 15 are carried forward, you will create the provision for the entire 15 days which are not utilized, irrespective of how many you expect to utilize in the coming year. Because if you don't utilize those 15 days, that is, you take only 10 days of leave, then for the remaining 5 you can claim an encashment, and as a result employer is under an obligation to pay for the entire 15 days in the next month if these are vested benefits. There are a lot of problems that are there in our material as well as the institute material pertaining to these compensated leaves. We have also given an example over here for your better understanding. So we've just broadly discussed the principles without going into too much of the actual calculative part over here. The important point that we need to remember is provision should be made for unutilized leaves which are expected to be utilized if these are non-vested leaves. If these were vested benefits, then you will create a provision for the entire amount irrespective of how much is expected to be utilized. Acha. Next, you have accounting for post-employment plans. Within post-employment plans, there are two broad categories. There is something called as defined contribution plans, and then there is something called as defined benefit plans. Defined contribution plans are plans where the amount of contribution to be made is defined and the actuarial or the investment risk is not borne by the employer. For example, when you look at statutory provident funds, the amount of contribution, that is 12% of salary, let us say, is the amount that is defined. After that, how much is the liability to be paid if the assets with the government's fund are not sufficient? These risks are not borne by the employer. Or if there's a group mediclaim plan, then as an employer, I have to pay the group medical insurance premium. The moment I pay that premium, after that, how many employees will fall sick, how much will be the benefits that I'll have to pay, do I have enough assets or not? None of these risks are on the employer. These types of plans are called as defined contribution plans, and the accounting for these plans is extremely simple. You will recognize the expense as and when the contribution amount accrues. So if the employee have rendered services in the current year for which there's a 10 lakh salary and 12% of that, that is 1,20,000 is something that has to be paid, then the defined contribution expense will be measured at 1,20,000. There's no rocket science over here, and hence you don't need services of an expert like an actuary. On the other hand, when you look at the defined benefit plan, in these plans, the amount of benefit is defined. Like we have defined 15 by 26 into last drawn salary into completed years as the benefit to be paid. However, here a lot of risks are on the employer, like if the last drawn salary suddenly increases beyond what you thought, or if, let us say, the investments that you had made, let's say you had created a sinking fund out of which you were planning to pay the gratuity, those investments kind of sink, in which case, will you still have to pay the liability? Yes, because you are under an obligation to pay the liability under a defined benefit plan. The amount of benefit has been defined irrespective of whether you contribute or don't. The amount of benefit is defined. In such plans, it is called as the actuarial risk, that is a risk that a liability can potentially change, as well as the investment risk, that is a risk where the investments in which you have made deployment may fall insufficient. The actuarial and or the investment risks will fall on the employer, and hence the valuation of these plans or the measurement of expenses under these plans will not necessarily happen based on the contribution that you make. However, they will happen based on the benefits that are accruing during the year, and hence you need to measure them using a special method called as the projected unit credit method, PUCM, where you can even use the services of an actuary. Remember, Ind AS 19 recommends the use of actuary services. However, it is not mandatory that the services of an actuary necessarily have to be used. Okay, so projected unit credit method is suggested for defined benefit plans. Now, as a theory part, the standard also mentions various types of plans, like a state plan, which is usually run by the government and hence it's a defined contribution plan, a multi-employer plan, which is like a mutual fund or a fund of funds, which is managing the retirement schemes of various companies. So in this case, you will have to look at the terms and conditions of the plan to determine whether it is a defined contribution or benefit. The standard gives a guidance that if you are unable to determine whether it is a defined contribution or defined benefit, we treat it as a defined contribution plan. Then there is a group share-based payment where, let's say there is a group company like Tata Group, there is a single plan which manages all the companies of Tata Group, in which case this is typically treated as a defined benefit plan because the risk is within the group. If the funds fall short, we will tell the group companies to pay for the same. And last is the insured benefits, like you approach insurance companies like LIC, for example, and take policies from them. Usually these are defined contribution, but again you need to look at the terms of the case. This is pure theory, not really important from an exam perspective. Now the core of the standard, in my opinion, starts from here, where you try to do the accounting for defined benefit plans, where you first try to measure the liability. and look at its presentation. A few key terms that you should be aware. First, there's something called as current service cost, which is a service cost which arises because of the service rendered by the employee in the current year. If the service was not rendered, then this cost would not have accrued. Second, you have interest cost, which arises like unwinding of discount in provision for site restoration, because the opening obligation now is one more year closer to payment. Third, you have past service cost, which arises if there's a plan amendment. Like earlier you had agreed to pay 1/2 into last one salary, now you have agreed to pay 1 month of the last one salary. So what this will ensure is the employee services which have already been rendered in the past will now be entitled to a higher degree of benefits, and hence past service cost. Then you have a very important term called as actuarial gains and losses. Now the measurement of the liability is based on what an actuary estimates based on projected unit credit method, but because the estimates can potentially change, the amount of liability can change. So the change in this due to the different assumptions that the actuary has used is called as an actuarial gain or loss. And this actuarial gain or loss, as you will study further, will be the only item, at least in the liability side, which will be taken in other comprehensive income. Everything else usually is adjusted against the profit and loss. And then there is something called as curtailment, also called as redundancies. This is kind of, in a simple way, an opposite of the past service cost. Past service cost increases your obligation. In case of curtailment, usually you reduce the plan benefits or reduce the number of employees covered under the plan, and hence the liability usually reduces. So this is a reduction. So we have kind of understood a lot of this using an example over here. I'll not go into the too much of the nitty-gritties. However, you can refer this example. The example over here says, so in this example there is a Mr. X who is joining the company and is the only employee of the company. He is offered a benefit of 1/2 into the last month's salary. So over here this is, let us say, 1/2 into the last drawn salary into completed years of service. This is a benefit. Now this is called as a defined benefit plan because the benefit amount over here is defined. The contribution is irrelevant. The amount of benefit is the true liability, and hence it's a defined benefit plan. So over here we have to follow the projected unit credit method. So what does PUCM say? It says that you project how many years the employees will continue in the service, what will be the last drawn salary then, and then as and when that service is rendered, you recognize the cost. So over here, if you can estimate on your own, you do that. Otherwise, you seek the services of an actuary, and these assumptions that you take are called as actuarial assumptions, where the actuary estimates that the last known salary when the employee is resigning is, let us say, 10,000. The estimated years of service are 5 years, out of which 1 have been served and 4 are yet to be served. And the discounting rate, which is typically the rate of the government bonds, because this is more like the opportunity cost. The money that I will be investing will typically be in safe assets, so government bonds. Let's say 10% government bond is the rate. Let us say this fund has no plan assets. So how will we measure the liability? So we have tried to explain the projected unit credit method through an example. I'll just touch upon the basics of this. So if I look at the benefit, it is 1/2 into the last drawn salary. So over here it is 1/2 into 10,000. Now the employee is expected to work for 5 years, but has he worked for 5 years? No, he has worked for 1 year and 4 years are still remaining. So the benefit which is attributable to 1 year of service is, let us say, 5,000. So before Ind AS 19 came in, what used to happen is you would have usually recognized this expense at the end of the 5th year because the amount of gratuity may not be determinable. However, Ind AS 19 says that that will be like a cash system of accounting, that is, you are recognizing gratuity only when it is paid. On the other hand, gratuity builds up as and when each year of service is rendered. So over here, as 1 year of service is rendered, 5,000 of benefit accrues. You don't pay that benefit now, you pay it at the time of retirement, but the benefit accrues because of the 1 year of service, and hence you will recognize a current service cost in the current year with the corresponding credit to a liability which is still payable. However, because it is post-employment benefit, so short-term benefits we did not discuss, I guess, but short-term benefits are within 12 months and hence you recognize them on an undiscounted basis, whereas post-employment benefits are typically beyond 12 months and hence the effect of time is material, and hence we recognize them at a present value basis. So we'll say, okay, 5,000 accrues because of the current year of service, but 5,000 will be paid 4 years from the end of the first year. Total 5 years, out of which 1 year is done, so 4 years are remaining. So this will be paid 4 years later. So in today's terms, let us say the discount rate is 10%. That means this is an expense of 5,000 into 0.683, and hence this will be approximately 3415 of expense. The journal entry for this will be P&L account debit for employee benefit expense, also sub-disclosed as current service cost to a defined benefit liability. Now, as each year passes, what will happen? As each year passes, one additional unit of service will be rendered. However, at the same time, the opening balance of the liability will now become one more year closer. And as a result, like unwinding of discount in provision for site restoration, we would say that at the beginning of the year, there is 3415. Irrespective of anything else, at the end of the year, that 3415 is now one more year closer. And hence, at the beginning, we will recognize interest cost. So 3415 into 10%, so that is 342 of interest cost. So this is again P&L account debit to liability. You are increasing the liability due to passage of time. But beyond passage of time as well, a second year of service is rendered, and hence there will be additional current service cost, which is another 5,000 accrued but payable 3 years later, because you are now at the end of the second year, and hence this is 5,000 into, for example, 0.7513, which will give you 3755, and the closing is 7512. Now, if you keep on doing this, at the end of 5 years, you will reach to 25,000, and if your estimates are accurate, then the employee will retire and his last round salary must have been 10,000, based on which you have to pay him 25,000. So your entry will be defined benefit liability account debit to bank. Now, obviously, by now you would have figured out that to get an accurate estimate is very difficult, and hence an actuary can keep on changing his estimate. So we have modified the example to say that what if at the end of the second or third year, over here, I think at the end of the third year, the actuary changes his estimate. He now thinks that the last round salary when the employee resigns will not be 10,000 but it will be 15,000. In which case, what will happen? Well, in such a case, if you were to measure the liability at the end of the third year, we would say that based on the revised estimate, the liability at the end of the third year, not current service cost, liability at the end of the third year will be 1/2 into, for example, 15,000 into 3 years. So this has been done till date into, you are at the end of the third year, into, let us say, the present value. So if you are at the end of the third year, 2 years are remaining and the discounting factor is 0.8264, and hence this is 7,500 into 3 into 0.8264, that is approximately 18,594 or 18,500 and something. However, your opening balance, which was 7512, will now become 1 year closer. So at 10%, your current service cost will be based on the current estimates. However, your closing will not tally. It will not tally because you are using different estimates at the time of closing, and that is called as changes due to actuarial assumptions. So over here, there will be changes due to actuarial assumptions, which is typically calculated as a balancing figure even by the ICAI. Again, there may be breakups of this, that is, some part of the changes may be due to demographics, some part of changes may be due to financing, a lot of different variables. However, at the end, this is a change due to actuarial assumptions, and this change due to actuarial assumptions is to be taken within remeasurement reserve as a part of other comprehensive income, and this is a part of a non-reclassifiable OCI, which means on the happening of certain events like the retirement by the employee and the payment of gratuity, the balance in the remeasurement reserve will directly be transferred to the retained earnings and will not be classified or reclassified to the statement of profit and loss. Now, sir, why is it going to the OCI? Well, no reason is given in the standard. However, the standard probably believes that actual assumptions can keep on changing, and hence in the current year, I might assume it goes from 10 to 15, I might then assume it goes from 15 to 12 or so on, and hence actual assumptions can keep on changing, and hence rather than letting it impact the P&L, we let it impact the remeasurement reserve. Items like interest, items like current service costs go in the P&L, however actual gains or losses go in the remeasurement reserve as a part of other comprehensive income. We kind of build up this example further where we say that, well, what if there's no change in the assumptions, but let us say in the fourth year, where your last round salary estimate is 15,000, in the fourth year, the entity amends the plan. So rather than giving a benefit of 1/2 of the last round salary, we agree to give a benefit of 3/4 into last round salary. That is, you increase the benefits. If you are increasing the benefits, that means the service that has already been rendered in the past, the last 3 years of service that have already been rendered in the past, which you thought will give you 1/2 into last round salary of 15,000, will now suddenly give you 3/4 into the last round salary into the completed years, and as a result, the service already rendered in the past will be entitled to a higher level of benefit because of this change, and hence this is called as past service cost. This is not an assumption change but a change in fact, and hence this is to be taken to the P&L account. This is past service cost. Alternatively, there can also be a curtailment, which is a reduction, which will also taken to the P&L account. So in case of liabilities, if I were to go to the actual setup of liabilities, so after a few slides, we have shown the presentation in the balance sheet as well. So if I were to go to the liabilities, I have to ask myself, why should the liability change? Your opening liability as per actuaries, and it will increase because of passage of time, so interest will be added. So on your opening liability, you will add interest. Apart from interest, there will be additional service rendered by the employees in the current year. So it will be added due to current service cost as well. The second effect of interest as well as current service cost will go in the profit and loss account. So if I were to prepare the profit and loss account, I will have the interest on the liability as well as current service cost, which is going in the P&L. Apart from that, the liability can potentially change because of past service cost as well, and past service cost will entirely be taken to the P&L account, whether it is vested or unvested, it does not really matter. It will be taken to the P&L account because it is a change in fact by the decision taken by the management. Now, we have all taken cases where liability is increasing. Now, liability might reduce if some of the employees retire and I have to make a payment, in which case the benefits paid will reduce the liability, and there can be potential curtailments or reductions, in which case also the liability might potentially reduce. Now, at the end of the year, you will go to actuaries and you will ask them to measure the plan. The actuaries will measure the plan, and if there's, like in our example, you got 18,500 and something in the third year, in which case if the balance does not tally, that is due to different estimates which are used by the actuary as compared to estimates which were earlier taken, and hence this is a change in actuarial assumptions which is taken as a part of remeasurement reserve in the other comprehensive income. So over here there is a remeasurement reserve in the other comprehensive income, out of which this balance will go. Now, this is one part of the defined benefit liability working. This detailed disclosure has to be given in the notes. The second part is plan assets. Now, what do you mean by plan assets? Plan assets refers to assets like in your CA foundation or inter CA, you must have seen provident fund and then provident fund investments. Now, these are like plan assets. These are assets which are earmarked, specifically ring fenced to pay off these liabilities. They they cannot be used for any other purpose. You can use trust structures, etc. to form plan assets. Now, plan assets can be comprised of qualified investments like investments in safe assets like government bonds or even insurance policies. Now, how do you measure plan assets like these investments? The standard says you will have to measure them at fair value. Why fair value? Well, because ultimately the decision on whether assets are sufficient, do I need to contribute more, depends on the fair value of the asset. So these assets have to be measured at fair value. No amortized cost, no historic cost, no. They have to be measured at fair value. And second, while presenting them in the balance sheet, we don't show the liabilities separately, we don't show the assets separately. In fact, we net them off and just show the net amount. Like we show debtors, less provision for bad debts and show the net amount. Fixed assets, less provision for depreciation and show the net amount. In a similar way, I will take the liability. Let us say my liability comes to 5,000 minus my plan assets are 4,000. So I will not show liability of 5 and a plan asset of 4. I will rather show 5 minus 4. That is the net 1,000, which is the net liability for the company as a whole. However, my liability is 5. Out of this 5, 4 has been arranged. So for the remaining 1, there is a pressure on my balance sheet which I need to show. Sir, why are we doing this? Well, because for big companies like Coca-Cola, General Motors, etc., generally plan assets are even more than the company's total operating assets. So if I show them on the asset side, it might kind of affect my ratios like return on assets and asset turnover ratio, because these are not assets employed in the regular business. So what I show is these are assets earmarked for the payment of liability. So while presenting in the balance sheet, I will take my liability minus my plan assets, and only the net amount, whether it is surplus or it is a deficit, will appear in the balance sheet. So two important things for plan assets. First, plan assets have to be shown at fair value. Second, they have to be netted out from the liability and only the net amount has to be shown in the balance sheet. Now, why should the plan assets change? There may be opening plan assets at the opening fair value. Why should it change? Well, it will change because of contributions which are done during the year. The entity might do some contributions to increase the amount of plan assets, so they might change due to contributions done during the year. Under defined contribution plan, this contribution goes to the P&L account. However, under a defined benefit plan, this contribution increases the plan assets and probably reduces the company's bank balance. It does not go as an expense in the P&L account. So contributions during the year will increase the plan assets, and if there are certain employees who are retiring during the year to whom you have to pay benefits, you will usually sell these plan assets, generate some proceeds and use those proceeds to pay off these employees. So benefits paid will reduce the plan assets. However, the closing amount will also have to be shown at the fair value, and this fair value is calculated by adding the return. The return over here can comprise of interest, can comprise of dividend income if investment is done in shares. It will comprise of realized capital gains, even unrealized capital gains, after considering all the necessary expenses like costs to manage this fund, taxes, etc. The net amount that you get is called as the actual return. So if at the beginning of the year, let us say there was 1,000 rupees in the plan assets, during the year no further contribution was made, no benefits are earned. However, at the end of the year, let us say 1,200 is appearing as a plan asset. How is it possible? Well, probably during the year some interest dividend must have been earned, and apart from that the value of these investments might have gone up, and hence the 200 is attributable, the balancing figure over here is attributable to what you call as actual return. And since it is a return, where should the return go? Well, the general thought process would be the return will go to the P&L account. However, institute does not make your life so simple. It over here adds a layer of complexity. It says that, well, most of the times these investments do happen in bonds, etc., and bonds are subjected to interest rate cycles. These plans are really long-term plans, so it is possible that in some of the years when the interest rate cycle is low, the return is less. Some of the years when interest rate cycle is high, the return is more. So actuary is supposed to estimate an average through the cycle return. Let us say the actuary says that the average return is 10%. However, in the current year, let us say you have earned 150 rupees. Expected return would have been, let us say opening, you have 1000 rupees. Let us say in the opening you have 1000 rupees. There is no contribution, no benefits. So on 1000 at the rate of 10%, your expected return is 100. So you should have ideally earned 100. However, if you see the closing, this is 1150, which means you have actually earned additional 50. So your actual return is 150, out of which 100 was expected, whereas 50 is a changes in return. So what does the standard say? That this 100 will go to the P&L account because this is expected on an average through the cycle, whereas this 50 will go to the other comprehensive income as changes in return as a part of remeasurement reserve. The logic over here being that in an upward interest rate cycle, yes, you are earning 50 more, but then when the interest rate cycle changes and you will earn probably less, then that 50 over here is kind of a gain in the current year. However, it's not really through the cycle going to be sustained every year. So in some years there's a gain, some years there's a loss. On an average, I expect 100 to continue. Some years I'll get more than 100, some years less than 100, and hence that 50, which is volatile, is going in the other comprehensive income as specifically instructed in the standard. So over here, your actual return is calculated as the expected return. Expected return is usually the opening into the expected return, assuming there's no contributions or benefits. If contributions or benefits are done, you have to look at the date. If they're done at the beginning, then you can also earn return on those contributions. If they're done at the end, you have not invested them, so there will be no return in the current year at least. Expected return plus or minus changes in return. Where will the expected return go? The expected return of 100 will go, let us say, in the P&L. Where in the P&L? Will it go in other income? No, it will be reduced from the interest on the liability. Like in the balance sheet, I show liability, and from the liability I subtract assets and I show the net liability. In a similar way, in the income statement, I'm showing expenses. Expenses arising out of the defined benefit liability. Now this income is helping me reduce those expenses, and as a result, I will subtract the interest that I get, the net interest as you see over here in the P&L over here on assets. I will subtract it, and hence the net amount can be shown in the P&L. Like assets and liabilities are netted off and net amount is shown in the balance sheet. Expenses and incomes are also netted off and the net amount is shown in the balance sheet. So over here, this will be opening fair value plus interest, which is the expected return. So your opening fair value, let us say, was 1000, and the expected return is, let us say, 1000 into 10%. Let us say hypothetically this is 100. Let us assume there is no contributions, no benefits paid, but your closing fair value comes to 1150, which means the remaining 50 is the changes in return where plan assets are increasing. So plan assets is debited. Then what will you credit? Well, the remeasurement reserve. This changes in reserve will go against the remeasurement reserve. So this is the effect which is arising due to remeasurement reserve, changes in return on plan assets. So for example, in our example, less 100 will appear so over here, whereas a 50 credit will appear over here. Okay, so this is about plan assets. I would rate this treatment of actual expected return and changes in return to be slightly important. A bit of practice is definitely needed. The presentation in the balance sheet, you will present the amount net. So you will take the liability minus the asset, and the net amount will be presented in the balance sheet. This amount is called as deficit. If, let us say, over here, if I have this handy, okay, so the closing liability, for example, is 3415. The closing assets is, let us say, 1100, in which case 3415 minus 1100 comes to, let's say, 2315. So this is 2315 net deficit. So your liability is greater than your assets, and hence this is treated to be a net deficit. So this is a net deficit appearing in the balance sheet usually. However, there's a special case which might sometime arise on something called as asset ceiling. Now, what do you mean by asset ceiling? Let us say over here, your net liability was only 500. Hypothetically, let us say your liability was only 500 and you have invested in plan assets worth 100 rupees, in which case the 600 over here is not a deficit. In fact, it is like a surplus. That means assets are greater than the liabilities. You have to pay 500, but you have provided for 1100, in which case this is a net asset appearing in the balance sheet. Now, what happens a lot of times is the companies must have formed trust structures where if I've contributed 1100, this 1100 is to be used for employee welfare. But employee welfare ke liye I'll pay 500, then that money is freely available. The remaining 600 can be used by the entity to pay off the other liabilities as well. In general, if nothing is mentioned, then 600 can be used to pay off other items as well. However, in certain funds, in order to prevent any kind of misuse, they prescribe what you call as asset ceiling, which means they say, let us say asset ceiling is 200 rupees, which means at max, even after all liabilities are paid off, 200 can be used for or drawn out by the organization for its purpose. Beyond that, you cannot draw. Sir, but I have 600. Well, what happens to the remaining 400? It has to be used for employee welfare. Like, if you remember in your CA Inter, if you have unclaimed dividend for 7 years, you keep it with you. After that, you have to transfer it to the Investor Education and Protection Fund. You cannot utilize it for your own benefits. In a similar way, in case of companies where there is an asset ceiling, you cannot utilize the amount for your own personal or the own company benefits, in which case you will have to restrict the withdrawals to 200. So over here, the net amount that can appear in the balance sheet is at best 200 rupees. So this is net debit. So this is net debit because assets are greater. This is also net debit. Assets are greater, and hence you have to pass an entry for 400. So is that a loss for you because you can never withdraw it? Well, on the paper it might appear. However, in practice, no, because in the next year, when the liability goes up from 500 to let us say 800, then it goes up from 800 to let us say 1500, what you will do is you will reduce your contributions. It is not that 400 is going to be a real loss. It is just that you can kind of meet up that loss by reducing your contributions. However, we cannot just show ke chalo apan aaj hi 600 balance sheet mein net dikhate, because as per the terms, balance sheet is as on date and you cannot withdraw 600 rupees out of the plan. You can at max withdraw 200, and hence 400 will appear as a part of remeasurement reserve. So your journal entry for the remeasurement reserve can be, you will credit the plan assets because this is net assets. So over here for this 400, you will credit the assets. Why? Because you are showing the net assets at 600, you want to show it at 200, and debit the remeasurement reserve, which is a part of OCI. So this is the third item. Plus or minus changes due to the effect of asset ceiling. So this is the third and the last item. Which is going to impact the other comprehensive income. Changes in the asset ceiling. The least important, in my opinion, is the effects due to asset ceiling, and this will give you the net amount to be shown in the balance sheet. This is the net amount to be shown in balance sheet. Remember, in case of deficit, that is a liability exceeding the assets, there is no application of asset ceiling because you're already having a net liability in the balance sheet. You'll show a net liability. What will you withdraw? You still have to pay off the liability. Only when the assets are in excess does the concept of asset ceiling, if any, get triggered, in which case you will restrict the amount to be shown in the balance sheet up to the asset ceiling over here. Okay, so if there is any other gain or loss on curtailment as well, you will record it, and this is how your presentation, this in my opinion, this part is the most important part of the standard. Institute loves asking, I mean it also loves you, but it loves asking you about the presentation. So as a chartered accountant, you are not necessarily required to do actuarial valuation. Then what will actuary do? We need to know how actuarial valuation is done, but you are not mandatorily required to do that. However, once actuary has done his valuation, you need to present this in the notes to accounts in this format in order to give the necessary disclosure. So 5 specific items. P&L, where you have current service costs plus the net interest cost. So interest on liability add, interest on assets expected subtract, plus past service costs, plus or minus gain or loss on curtailment or redundancies will give you the net amount to be shown in the P&L. In the other comprehensive income, you will have gains or losses due to actuarial changes on liabilities, changes in return on plan assets, and changes due to the effect of asset ceiling. That will be the net amount to be shown in the OCI. Then when you are preparing the liabilities, your opening liability as per actual valuation increases due to the interest on the liability plus the current service cost plus the past service cost, plus or minus the changes in actuarial assumptions, less the benefits paid, less curtailments if any, will give you the closing. On the assets, it's very simple. Opening plus expected return plus contributions minus benefits plus or minus changes in return, which go to the OCI, and hence you get the closing fair value. In the balance sheet, you will present the amount net. So you will start with the closing liability, subtract from that the opening subtract from that the closing fair value of the plan assets, the net deficit or surplus, adjusted for the effect of asset ceiling if there is a surplus, and if there is an asset ceiling, then the net amount appearing in the balance sheet. So a lot of technical things over here which you need some practice, but once you get that, it's fairly easy to kind of go around with the workings here. Now there are a few questions in your study material which are specifically focused on you having to determine the attribution of the current service cost. Current service cost. From when will you start attributing current service cost? You will start attributing current service cost when one unit of service gives rise to one additional unit of entitlement. Like the plan of your company might be that for employees who are having more than 25 years of age, for each year of service we will pay them, let us say, 150 rupees, for example. We may pay them at the time of retirement or whenever, but we'll pay them 150 rupees. Now, if you are an employee who is 20 years old and you are rendering 1 year of service, then your 1 year of service is not contributing anything to you getting an additional entitlement. Because you are 20, you are now becoming 21, then 22, 23, these services do not give you any right to receive 150. However, you are now 26 years of age and you render 1 more year of service, then the 1 more year of service that you have rendered will give you entitlement to 150, which you might get in the future. So you might do a present value working, but it will now give you access to that 150. So you will start recording once a unit of service gives rise to additional unit of entitlement, and you will stop recording current service cost once the additional unit of service does not give rise to any additional unit of entitlement. Like the company has a policy that once this benefit will be continued till the time employee touches 35 years of age. Beyond 35, if service is rendered, no additional benefit is rendered. In which case, we will say that for each year of service rendered between 25 and 35, 150 rupees in present value terms can be adjusted. But the moment you touch 35, now you continue to render service. You are giving 1 more year of service. You are 36, you are 37, you are 38. That 1 more year of service does not give rise to any additional unit of entitlement. So the attribution starts from the point where 1 unit of service gives rise to 1 additional unit of entitlement, continues till the time that additional unit of service does not further give rise to any further unit of entitlement. Now, in certain problems, especially there are 2 problems in your study material where a problem might arise where the benefits are different for different years, in which case the standard says that if a year of service or if employee service in later years gives rise to a materially higher level of benefit than that of the earlier years, then you do straight line. Like there's a sum of medical plan in your material where it is told that if an employee has rendered more than 10 years of service, then he gets, for example, 10% of the medical reimbursement. If he has rendered more than 20 years of service, he gets 50%. So here what happens is, for the later years of service, so even if he renders the first 10 years, he is entitled to 10% medical reimbursement. But if he renders for another 10 years, that is between 10 to 20 as well, another 10 years, and he crosses 20 years of service, he will now get 50%. And hence, the service rendered in the later years, that is the last 10 years, gives rise to materially higher level, that is 40%, as compared to the first 10 years, which gives rise to only 10%. In such cases, the standard says you do straight lining. And hence, if an employee is expected to render let's say 25 years of service, then we will say that, well, he will be entitled to 50% reimbursement, and that 50% will be spread on a straight line basis in the entire 20-year time frame. So 50 divided by 20, that will be 2.5% each month. However, a similar problem is given in your study material where you have been told that if the employee renders 10 years of service, then he will be entitled to 40% benefit, and if he renders more than 20 years of service, then 50%. In which case, for the first 10 years, he is getting 40%, and the next 10 years, he is getting an additional 10%. In this case, if you see the institute solution, they have done for the first 10 years of service, if an employee is expected to continue beyond 20 years, let us say, they have done for the first 10 years of service, 40% divided by 10, that is 4% per annum, and for the last 10 years of service, 10% divided by 10, that is 1% per annum. This is where students get confused. They say, sir, that this is a printing mistake. Both of them are showing different versions. They are not showing different versions. They are respecting what the standard has mentioned. Standard is saying that if it does not say you always do straight lining, or it does not say you always do proportionate working. It says if the service in later years gives rise to a materially higher level of benefit as compared to service in the earlier years, then you do straight lining. So in our first example where it was 10% in the first 10 years and the remaining 10 years if you render another 40%, that is a materially higher level of benefit, and hence you did straight lining. On the other hand, if in the second example where there was 40% in the first 10 years and then only an additional 10% in the remaining 10 years, it is not materially higher level of benefit. Materially higher kitna hota hai, that has not been defined, but this is by observation. It is not a materially higher level of benefit, and hence no straight lining is required. So this is one point that you should keep into consideration. Now, the last two parts of the standard are other long-term benefits and termination benefits. To be honest, in other long-term benefits, the accounting is cut, copy, paste, exactly the same as post-employment benefits. You have to consider time value, you have to do the actuarial valuation, everything. There will be current service costs, there will be interest costs, there will be past service costs if applicable, and there will also be changes due to actuarial assumptions. There can be plan assets, everything remains the same. The only point of difference that you have to remember is there will be nothing called as remeasurement reserve, because Ind AS assumes that post-employment benefits inherently are very long-term benefits, and hence the period is very long, and hence you can take these changes in return or assumptions into the other comprehensive income. However, long-term benefits inherently are usually shorter than the post-employment benefits, and as a result, the period may not be as long to cover multiple cycles, and hence we will not touch the other comprehensive income, whatever were the three items: changes in actuarial assumptions, changes in return on plan assets, or changes due to the effect of asset ceiling, which were earlier going in OCI, will now go into the P&L account if it's another long-term benefit plan. So if the same question comes that you have studied for post-employment, it comes as other long-term benefit, your accounting will be exactly the same, except for the fact that the three items which went into the other comprehensive income will now go into the P&L account directly. There will be no OCI that you need to create over here. That is one point of difference that you need to remember. And lastly, there is something called as termination benefits like VRS or retrenchment. The standard over here says that you will have to identify how much of the benefit is actually linked to termination, and you will recognize that as an obligation when the obligation to terminate arises. So there is a good example which is given in our books as well as in the study material, where they say that, well, there is a company which has 120 employees and it says that it wants to terminate after 10 months. The obligation to terminate exists. However, if employees were leaving before 10 months, let us say immediately, I'll pay them 10,000. Employees were leaving, let us say after 10 months, I'm paying them 30,000. So a student believes that, okay, the termination benefit is 10,000 for employees who are leaving immediately, 30,000 for employees who are leaving after 10 months. The standard says no. The benefit which is linked to termination is 10,000 only. The remaining additional 20,000 that you are paying to employees who are continuing for 10 months is because they are continuing for 10 months, and hence that is current service cost. Termination cost is 10,000 only and will be recorded for all the employees once the obligation to terminate arises. That is, it can be a legal obligation where there is a government order, or it can be a constructive obligation where you have where there's a formal plan in place and you have communicated the plan and the employees are kind of aware. So you will recognize the provision for termination benefits when the obligation to terminate kind of arises. Additional guidance for this, you can even refer Ind AS 37, where you have provision for restructuring, where an additional guidance is given for the timing. Okay, so in this chapter, I would say within short-term benefits, compensated absences or paid leaves are important. Within post-employment benefits, the understanding of the defined benefit liabilities and plan assets, and especially the presentation that we have in this table over here, is extremely important. From an exam perspective, yes, institute material has some sums on attribution of current service costs, etc., but they don't really turn up into the exam as much. This part of post-employment benefits, either the calculative part where we discuss this example, or the presentation part where you are given the numbers and you have to present it appropriately, is, in my opinion, the most important part of this standard. I hope this video has been helpful to you. Keep studying. Wish you all the very best, and I'll see you soon with another video. Till then, goodbye, good luck, and take care.